Okay, let's go ahead and start looking at the cases where there is a partially owned subsidiary. And we'll start with it being acquired at book value, that way there's no differential to worry about. Now, the consolidated financial statements are prepared from the perspective of the parent corporation. There are going to be two owners, or two groups of owners. First, we have the controlling owner. This is the parent corporation, and generally, the controlling owner owns more than 50% of the subsidiary's voting stock. The other owner or owners own less than 50% of the voting stock. Now, historically, these groups were referred to as the majority interest and the minority interest. And this was based on the general idea that control was acquired via ownership of a majority of a firm's voting stock. However, since control can be held or attained by means other than majority ownership of voting stock, it's become preferable now to refer to these groups as the controlling interest and the non-controlling interest. You still occasionally see the non-controlling shareholders referred to as the minority interest. Again, since I believe the late 90s, perhaps the early 2000s, the preferred terminology has been controlling and non-controlling interest, but old habits die hard. Now, how do we present our partial ownership of the subsidiary? Again, the consolidated financial statements are prepared from the perspective of the parent corporation, big company. Now, the controlling shareholders own 100% of big company and 70% of little company. To present this economic entity, should we simply present 100% of Big's accounts, their assets, liabilities, equity, revenue, and expense, plus 70% of Little's accounts? The problem with that is that we're presenting Big and Little as a single economic entity. The economic entity includes 100% of the assets, liabilities, revenues, and expenses of both companies. This is the economic entity. The entity is comprised of 100% of each company. What we need to do is to report 100% of both companies, while at the same time disclosing that the controlling shareholders don't own all of little company. So how do we get across the idea that we own only 70% of Little's assets, liabilities, and so on? Should we show 100% of Big's assets and then add only 70% of Little's assets? And similarly for liabilities, should we report 100% of Big's liabilities plus only 70% of Little's liabilities, and the same for revenues and expenses? Now, this was the approach followed years ago, and it focused not on the economic entity aspect, but rather on the ownership aspect. It only reported that portion of Little that was owned by the parent company shareholders. And the problem is this gives a misleading view of the economic entity. The actual economic entity, Big plus Little combined, has 100% of Big's assets and 100% of Little's assets under their economic control or direction. Reporting only 70% of Little's assets on the combined balance sheet would fundamentally misstate the nature of the assets controlled by this economic entity. Similarly, listing only 70% of Little's liabilities on the combined balance sheet would fundamentally understate the obligations of the combined entity. And the same arguments would apply in the case of revenues and expenses as well. Reporting only 70% of Little's revenues and expenses on the combined income statement would not give an accurate portrayal of the total revenues and expenses, the earnings power of the combined entity which we're reporting. What we're going to do instead is we're going to go ahead and combine 100% of Big's assets, liabilities, revenues, and expenses with 100% of Little's accounts, and then allocate or deduct out that portion of the total net assets and the total net income which is owned by or claimable by or attributable to the non-controlling interest. Now, in a single company, the total net assets, assets minus liabilities, are matched against or equal to the owner's equity. In the new consolidated financial statements, when there is a non-controlling interest, the total net assets will be largely claimed by the parent equity holders, again, the big company shareholders, but we will also create an equity-like account called the non-controlling interest, which represents the portion of the net assets controlled by the non-controlling shareholders. Now, again, our basic accounting equation is assets equals liabilities plus owner's equity. Rearranging that a little bit, we get net assets equals owner's equity. Now, when we combine big and little, we're going to have the combined net assets, but now we have two groups of equity holders, two groups of claimants. We have the parent company shareholders, who again, they own all of big company plus a majority of little company, but there are also these other equity holders who own a sliver of little company. They don't own any of big company, but they do own a portion of little company, and little company has been combined with big company. So on our balance sheet, we're going to have now two equity claimants. We're going to have, the majority of it is going to be the big company shareholders. So we're going to have Big's common stock, Big's additional paid-in capital, Big's retained earnings, and so on. Plus, we're going to have this new equity-like account called the non-controlling interest. We're going to do something similar with the income statement. On the income statement, we're going to take a similar approach, but rather than dividing up total net assets between the two claimants, we're going to divide up the total net income between the two claimants. So we're going to go ahead and combine all of the revenues of big and little and deduct the total combined expenses of big and little and arrive at a subtotal referred to as consolidated net income. Again, this is the combined earnings of big and little. Now, of that combined or consolidated net income, again, the majority of that, presumably, is owned by or claimable by the controlling shareholders, but there are these other equity holders, the non-controlling interest, who own a portion of the subsidiary's income. They own a portion of Little's earnings. So of that consolidated net income figure, we're going to go ahead and deduct out or allocate away the portion owned by the non-controlling shareholders. We'll refer to that as the income to the non-controlling interest, and then whatever's left is the income to the controlling interest. Now, this income to the non-controlling interest, or in some 10Ks you see it referred to as non-controlling interest in earnings of subsidiary or something to that effect, is not an expense. It is an allocation of earnings to another party. Rarely you'll still see it on a company's 10K listed as non-controlling interest expense. I know I found one like that, perhaps 5 years ago. I should have written it down what company it was, but again, it's not supposed to be an expense. It's not an expense. It shouldn't be called an expense. It is an allocation of the combined earnings. Let's go ahead and run through an example, and first let's do the consolidation at date of acquisition. So let's assume that on January 1st, 2001, Big Company acquires 70% of Little Company for $210,000. Little Company's book value on that date is $300,000. All of their assets and liabilities have fair values equal to book values, and the fair value of the non-controlling interest is $90,000 on that date. The first thing we do is our cost versus book value equals differential analysis. And so again, the cost of our 70% was $210,000. The total fair value is $300,000. Again, that's the cost or the value of our share, $210,000, plus the value of the non-controlling interest, $90,000. We then subtract out the book value, and again, the total book value was given as $300,000. Our share of that, or 70%, is $210,000. Leaving us with a zero differential. Okay, so here's our consolidation at date of acquisition worksheet. And you'll note that, instead of listing a bunch of individual assets and liabilities, I simply listed net assets. So Big Company, they've got their $210,000 investment in Little, plus they have $790,000 in other net assets, so cash, receivables, inventory, property, plant, and equipment, less all other liabilities. So they have $1 million even in assets, matched by $1 million in equity. Little company has $300,000 in net assets, matched by $300,000 in equity. And please note that the non-controlling interest does not appear on either company's individual trial balance. The non-controlling interest is created as part of the consolidation process. Now, the combined economic resources of Big and Little is $1,090,000. Again, Big has $790,000 of economic resources. Little has $300,000 of economic resources. Big's investment in Little represents their proportionate ownership of Little's net assets. So if we were to add that $210,000 investment in Little into the mix, we would again be double counting, or almost double counting, Little's net assets. So the two companies combined have total economic resources, net economic resources, of $1,090,000. And the question is, who owns those economic resources? Again, Big Company owns 100% of Big's economic resources, $790,000, plus they own 70% of Little's $300,000 or $210,000 worth. So Big Corporation owns $1 million of that $1,090,000 in economic resources. So to present this, we're going to, as always, eliminate the subsidiaries' owner's equity accounts. So we're going to go ahead and debit common stock for $100,000 and debit retained earnings for $200,000. That will eliminate the subsidiaries' owner's equity accounts, leaving us solely with Big Corporation's owner's equity accounts. And we're also going to go ahead and eliminate the investment in Little with a $210,000 credit. Now, looking at the debit and credit columns, obviously they don't balance. We have $300,000 in the debit side, $210,000 in the credit column. The missing $90,000 in the credit column is this non-controlling interest equity account that we're going to go ahead and create. So looking at our worksheet, what we're doing is we're going to be combining the total assets, the total net assets of Big and Little, excluding that investment. We're going to be eliminating the investment because we can't have an investment in ourselves. In the owner's equity section, we're going to be eliminating Little, the subsidiary's equity, leaving us only with Big's common stock and retained earnings. And then finally, we're creating this $90,000 non-controlling interest representing the non-controlling shareholders' ownership of a portion of one of Big's subsidiaries. So our elimination entry, we're going to again eliminate the subsidiaries' owner's equity accounts as always. We're going to go ahead and eliminate our beginning of year investment in Little account. And we create that non-controlling interest equity account. Now, I always refer to that as an equity account or as an equity-like account. That account has had sort of a peripatetic existence over the years. It's not a liability. Again, a liability is an obligation to transfer resources based on a past transaction or something to that effect. And it's not really an equity account proper on Big Company's balance sheet. Again, it doesn't represent any ownership of Big Company at all. It represents a partial ownership of one of the subsidiaries of Big Company. And so the account has sort of bounced around over years. Occasionally it was put in the liability section. That's clearly wrong. But people were uncomfortable putting it in the equity section, and so it was often presented in the mezzanine between liabilities and owner's equity. For the past 10 years or so, the official rule has been that it's presented in the owner's equity section at the bottom of the owner's equity section. So let's go ahead and post that to our worksheet. Again, you'll notice there that in posting this, I've put, again, little letters next to each of the entries in the adjustment or elimination columns, little S's standing for the S entry. And again, as you know, in this is a very short, simple example, so it's not necessary. But in longer, more complex examples, it's going to be, you might find it very useful to put a little letter next to the entry in the worksheet indicating what elimination entry that number came from. So these all came from the S entry. We should go ahead and foot the adjustment columns just to make sure we're not overlooking anything. So we have $300,000 total in the debit column, $300,000 total in the credit column. If those two footed totals don't match, then obviously we made a mistake somewhere in posting. So this gives us some assurance that we're doing things properly. It's not a guarantee, but it gives us some assurance that we haven't simply overlooked something or put a debit in the credit column or vice versa. And now we simply add across each row. Again, net assets, combined economic resources, $1,090,000. The investment in little account gets eliminated. That always goes to zero. That's one of our sort of reliable check figures. No matter what else happens, the investment in little must go to zero. The paid-in capital accounts, again, we eliminate the subsidiaries paid-in capital, leaving us with the parent's common stock account. And likewise with retained earnings. We eliminate the subsidiaries' retained earnings, leaving us with the parent's retained earnings. And then finally we have this new equity-like account, non-controlling interest, with a balance of $90,000. And again, that represents the portion of the combined net assets owned by the non-controlling shareholders. Let's go ahead and take this a little bit further and deal with consolidation after acquisition. So this will be the end of the first year following the preceding acquisition. We'll assume that Little had income of $30,000 and that Little paid dividends of $10,000. Now, again, let's assume that this is the worksheet at the end of the first year following acquisition. And a worksheet with aggregated data might look like this. And again, I've aggregated all of the assets and liabilities into a simple net asset figure aside from the investment in Little. And I just want to talk real briefly about where some of these numbers came from. These numbers aren't really chosen at random. Certain relationships have to hold. Now first, in no particular order, Little has reported income of $30,000. That means that, again, it doesn't matter what number I chose for revenues as long as expenses were $30,000 less. Second, given that Little had income of $30,000 and that Big owns 70% of Little, Big's investment income must be 70% of Little's reported earnings. The investment in Little account needs to equal the beginning of year investment balance, which again was $210,000, plus Big's share of Little's income, which was $21,000, less Big's share of Little's dividends, or $7,000. So the end of year investment in Little must be up to $224,000. Again, that's an end of year figure. The beginning retained earnings is from the date of acquisition information, as are the common stock accounts. The ending retained earnings shown on the balance sheet is blank for the moment. We'll go ahead and fill that in as we go through the income statement and statement of retained earnings for each firm. Again, at this point, I'm just running through the trial balance, which is sort of the foundation for our consolidation worksheet. Please note that there are two accounts related to the non-controlling interest. Up in the income statement, we have the income to the non-controlling interest. And again, that's going to be the portion of the consolidated income allocated to the non-controlling shareholders. Down in the owner's equity section of the balance sheet, we have the non-controlling interest. And again, that's the equity-like account representing the non-controlling shareholders' ownership of their share of the subsidiary. And again, please note again that the non-controlling interest doesn't exist on either the trial balance of big or little, it is created from scratch, is created anew each year as part of the consolidation process. The net assets account have balances which are essentially plug figures to make the trial balances of big and little balance. And again, if instead of simply listing a single net asset figure, I had listed all of the individual assets and liabilities, basically what's required is that the sum of all those net assets must be enough to make the trial balance balance. Now, that's not an arbitrary number. Look at Little for the moment. Again, at the beginning of the year, the date of acquisition, Little had net assets of $300,000. Their net assets increased by $30,000 due to their earnings for the period, and then went down by $10,000 due to the dividends that they paid out. So the end of year net assets would be $320,000. Now, before doing anything else, let's go ahead and complete the big and little columns. The income statement for each has already been filled in, so next we need to do the statement of retained earnings. Again, we take the income figure from each company individually and transfer it down to the statement of retained earnings. So for each company, beginning retained earnings plus income less dividends equals ending retained earnings. And then we transfer that ending retained earnings figure down to the balance sheet. So at this point, we should have a completed balance sheet for both big and little individually. And at this point, it wouldn't be a bad idea to confirm that the balance sheet for each individual company balances. In reality, they would have to. They should balance. Going through problems in class, it's entirely possible that I or the textbook authors, in creating a problem, might make a mistake in setting up the problem, and the balance sheet for either big or little individually will not balance. If the balance sheet for either company individually does not balance, then the consolidated balance sheet will not balance either. And you can go nuts trying to figure out what mistake you made, when in fact the mistake was in the initial balance sheet for either of the individual companies. Now, before we go any further, let's look at the example and consider what result would make sense. Big company had $29,000 of income from their own sales and their own expenses. Again, they had revenues of $300,000, they had expenses of $271,000 for earnings of $29,000. Again, not considering their investment income. Little company had $30,000 of income. So the combined earnings of both companies from their sales to external customers less their expenses would be $59,000. If we were to simply add across the income row, that's not the result we get. We would get $80,000, and that's incorrect. The problem is, of course, that $80,000 double counts a good portion of Little's earnings. It includes all of Big's income of $50,000, which includes their 70% of Little Company's earnings. That's why it's so important that whenever you come to a subtotal or a total on the consolidated income statement or balance sheet, you need to work your way down the consolidated column. So combined or consolidated revenues $400,000 less combined or consolidated expenses of $341,000 equals consolidated income of $59,000. Now, of that $59,000 of combined total earnings or consolidated net income, the controlling shareholders don't own all of that. The non-controlling interest has a claim on 30% of Little's income. Again, Little's income is $30,000. The non-controlling shareholders own 30% of that, or $9,000. So we're going to go ahead and allocate away $9,000 of that consolidated income to the non-controlling shareholders, leaving the remaining $50,000 for the controlling shareholders. Now please note that that $50,000 is equal to the income figure for big. That will always be the case if big company uses the full or complete or complex equity method. The equity method is sometimes referred to as a one-line consolidation if and only if the full or complete or complex equity method is being used. Under the full equity method, we take full account of all of the effects of the interrelationships between big and little. Now, in a lot of cases, both in real life and in the classroom, we're going to use the partial or modified equity method. And in that case, that nice reassuring check figure that the income to the non-controlling shareholders and big's net income will not be equal. Okay, so let's go ahead and start going through our elimination entries. First, as always, we have our S entry, where we eliminate the subsidiaries' beginning of year equity accounts. So we have a $100,000 debit to common stock and a $200,000 debit to retained earnings. Again, as always, please note that we're adjusting or eliminating the beginning retained earnings up in the Statement of Owner's Equity section. You should never see an adjustment or an elimination down in the ending retained earnings down in the balance sheet. We always adjust beginning retained earnings, and that flows through our statement of retained earnings to affect ending retained earnings. We also go ahead and eliminate our beginning of year investment in little account, and we also create that beginning of year non-controlling interest. A for amortization, not applicable because again there was no differential. I for income. Now again, this should be the easiest entry of them all. We look up at big company's income statement. The third line down in big company's income statement is investment income with a balance of $21,000. That number has to go away. I can't tell you how distressing it is to see students always making this so much harder than it has to be. Again, it's not little's income of $30,000. It's not any amortization entries that might take place. Basically, whatever the investment income is on big's income statement, that number has to go away in this elimination entry. So we debit investment income for $21,000. Again, positive investment income would be a credit balance, so to eliminate it, we debit investment income, and we credit the investment in little. And again, in posting these two entries to the worksheet, again, please note that I've put little S's and I's as appropriate next to each number. And again, as we get to more complex examples, if something doesn't balance, it's nice to be able to go back and trace through entry by entry to make sure you're posting things correctly. Without the little S and I and so on in the debit and credit columns, it can be kind of hard to see where which entry each number came from. D for dividends. As before, we credit dividends to eliminate the subsidiary's dividends, and now that dividend is split between the parent's investment in little and the non-controlling interest. Now recall that under the equity method, when we received dividends from the subsidiary, that reduced our investment account. The idea being that our investment represented our proportionate ownership of the subsidiary's equity. When the subsidiary paid out dividends, that reduced their equity or their net assets, thereby reducing the value of our investment. And the same thing applies with a non-controlling interest. When the subsidiary pays out dividends, that reduces the net assets of the subsidiary, therefore reducing the value of that non-controlling interest, because the non-controlling interest represents their proportionate ownership of the subsidiary's net assets. Finally, our new entry, INC, for income to the non-controlling interest. Again, we have, as mentioned earlier, we're going to have $59,000 of combined or consolidated net income. Now, the parent company shareholders don't own all $59,000 of that income. The non-controlling interest owns 30% of little's reported earnings. So again, we're going to go ahead and allocate 30% of $30,000 or $9,000 to the non-controlling shareholders, and that increases the equity claim of the non-controlling interest. So we debit income to the non-controlling interest, and again, that's a debit up in the income statement. That's going to be subtracted. It's not a reduction of income, it's an allocation of income. And we credit or increase the equity claim non-controlling interest. Okay, now that we've recorded all of our elimination entries and posted them to the worksheet, the final step before going any further is it's always a good idea to foot the debit and credit adjustment columns to make sure that you've posted things properly. So if we add up all the debits in the debit column, we have 21,000 plus 9,000 plus 200,000 plus 7,000 plus 100,000 plus 3,000 equals $240,000. In the credit column, 10,000 plus 210,000 plus 21,000 plus 90,000 plus 9,000, $340,000. So the total debits equal the total credits. That's reassuring. It's not a guarantee that we did it right. We could have put a debit in the wrong row, and that would not show up as something being out of balance, or we could have neglected to record an entry entirely, in which case, again, it wouldn't be out of balance. But at least the fact that the total debits equal the total credits gives us a little bit of an assurance that we didn't, record a debit but not a credit, or mistakenly put, two debits instead of a debit and a credit. So it is a little bit reassuring. If the totals don't equal, then again, you've made a mistake. You got to stop and go back and figure out what you did wrong. And again, this is where having the little s and the a and the I and the d and the inc next to your entries is going to be really helpful in tracking down mistakes. Okay, let's go ahead and run through our worksheet. Again, we add across revenues. So the combined revenues are $400,000. We add across the expenses. So the combined expenses are $341,000. And the investment income, as always, goes to zero. Again, that's one of our comforting check figures. The investment income always has to be zero. So we work our way down the consolidated income statement, and we get consolidated net income of $59,000. Now again, of that $59,000, $9,000 is allocated to the non-controlling shareholders, leaving $50,000 for the controlling shareholders, or the controlling interest. That's the number we transfer down to the consolidated statement of retained earnings. Again, the retained earnings number on the balance sheet represents retained earnings of the parent company. So we only want the parent or controlling interest's income included in that number. The $9,000 that went to the non-controlling interest, that's going to be included in the non-controlling interest in the owner's equity section. So now we can go ahead and work through the statement of retained earnings. We go ahead and add across beginning retained earnings. So again, as always, we eliminate the subsidiaries' beginning retained earnings, being left with the parent's retained earnings. We have the income figure. Dividends, again, as always, we eliminate the subsidiaries' dividends, being left solely with the parents. And again, we work our way down the consolidated statement of retained earnings. Beginning retained earnings plus income less dividends equals ending retained earnings of $620,000, which we then transfer down to the ending retained earnings on the balance sheet. And now we're in a position to go ahead and work through our balance sheet. We go ahead and add across the net assets. So Big's net assets, excluding their investment, $796,000 plus Little's net assets equaling combined net assets of $1,116,000. Our reliable check figure, the investment in Little, when we add across that row, that has to come out to zero. If that doesn't come out to zero, we've made a mistake and we have to stop and go back and figure out what the mistake was. But very comfortingly, that adds up to zero if we add across. the common stock account, again, as always, we eliminate the subsidiary's common stock, being left with the parents only. We've already got the retained earnings cell populated with that $620,000 number, and that's one of the benefits to transferring that $620,000 down from the retained earnings statement down to the balance sheet right away. If we hadn't transferred that down right away, there would probably be a temptation to simply add across the retained earnings row. 620,000 plus 220,000 equaling $840,000. Obviously that would be wrong, so it's nice, again, once you get the ending retained earnings figure, immediately transfer it down to the balance sheet so that cell is filled up so you don't make the mistake of simply adding across. Okay, finally we can add across the non-controlling interest row, and again, in the S entry we created the beginning of year balance of $90,000. We added to their equity claim their share of Little's reported earnings, and then we subtracted their share of the dividends that Little paid out. So 90,000 plus 9,000 less 3,000 leaves a non-controlling interest of $96,000. So we've completed our worksheet, and now we can simply take these sections and create our financial statements. The top, in this case 6 lines, become our consolidated income statement. The middle 4 lines become our statement of consolidated retained earnings, and the bottom 5 lines become our consolidated balance sheet. Okay, that was long. That was 36.5 minutes. And if anybody is still listening, please email your instructor and say, hey, I listened to the whole thing, and you'll score some valuable bonus points selected especially for you.